The 10-year Treasury yield is the single most important number in global finance. It just crossed a critical threshold that has only happened 5 times in the last 40 years. And every single time, the stock market did something unexpected within the next 6 months. Here's what the bond market is telling us, and why most investors are reading it completely wrong. Welcome back to Wealth Code. I'm your host, and today we're talking about the 10-year Treasury yield, the force that quietly moves trillions of dollars around the world, while most retail investors aren't even watching. Right now, the yield on the 10-year U.S. Treasury note is hovering near levels that historically precede major market shifts. We're seeing the yield curve steepen in a way that economists call the normalization trade. But what does that actually mean for your portfolio? In the next 10 minutes, I'm going to explain exactly what's happening in the bond market right now, why the Federal Reserve is watching this number like a hawk, and the 3 asset classes that always perform when yields behave this way. Let's break it down. Here's the situation as of this week. The 10-year Treasury yield is trading near the highest levels we've seen since the post-pandemic rate hiking cycle. And here's what's interesting. It's not because the Fed is hiking rates. In fact, the Fed has been signaling that they're done raising. They're talking about cuts. So why are yields going up? Because the bond market is smarter than the Fed. The bond market prices in what the Fed will do 6 months from now. This is the kind of insight that every investor, every serious investor, should understand. That's the story unfolding right now. To 12 months from now, not what they're saying today. When long-term yields rise while the Fed holds short-term rates steady, the yield curve steepens. And a steepening yield curve in a late-cycle economy has historically been a signal for one thing: inflation that refuses to die, or growth that surprises to the upside. Either way, it changes everything for how you should position your money. Based on historical data from the last 5 times the 10-year yield crossed this level, here are the 3 asset classes that outperformed every single time. Number 1, financial stocks. Banks make money on the spread between what they pay for deposits and what they earn on loans. When the yield curve steepens, that spread widens. Regional banks, money center banks, and even insurance companies, they all benefit. The last 3 times this happened, the Financial Select Sector SPDR fund returned an average of 18% over the next 6 months. Number 2, commodities. When bond yields rise on